Welcome, welcome. Happy 2025, my fellow real estate investors. We have a wonderful, wonderful presentation for you guys today. Wealth building with real estate. We're going to be going through all of that and more. I get the pleasure of hosting, and guess what? It's my birthday. So my birthday surprise, I get to give you guys the book that the team has been working so hard on. Real Estate Syndications 101. We're going to be going through that. Those of you attending today live will get a copy of the book, my birthday gift to you. I wish I could say that I put it together and made it look pretty, but it was actually the team that made it look really pretty. So we'll be celebrating that together in just a moment. We'll be giving that copy of that to everybody. So lots going on with the real estate market right now. Many people are starting to watch and speculate the jobs report that's supposed to come out tomorrow, because it could affect how the Federal Reserve pulls the next lever on interest rates. You see, the Federal Reserve is coming together at the end of the month, and they're closely watching the unemployment rate. And that's supposed to be the biggest weight that's going to come down in determining whether they're going to follow their current course or if they're going to rescind. So let's watch and see together. Lots to cover today. I am your host. My name is Nate Armstrong. I am co-CEO of HomeInvest. I'm going to be joined in just a little bit here by my partner and co-CEO, Chris Lavin. We are a faith-forward investment firm. And our tagline, Believe in More, has allowed us not only to make incredible returns for our investors, but it's also let us bless the communities that we own assets in. I got the pleasure last month of going on site to one of our buildings, and we did a big Christmas party for the tenants. And we had toys for tenants. We got to see one family, it's specifically one of the moms in the community. She had told us before the Christmas gathering, when we asked her daughter's age to buy the gift, she said, I didn't think we were going to be able to do gifts this year. She was really touched by it. So when we say believe in more, we really believe in more for our investors, for their returns, and more for what we can do for humanity, for our communities. So if you believe more is possible for your investments, you're in the right spot. Let's go ahead and jump in. I want to introduce Mr. Chris Lavin. Chris, are you there, man?
I am. I'm here. How's everybody doing?
Good. So Chris, we'll do the full intro of you a little bit later, but you are a professional MMA fighter, so that qualifies you to be here on a financial webinar, right?
Absolutely. 100%. They transition right from one to the other.
Yes, it does. Cool. So we're going to bring Chris back up in just a little bit. Chris is a very successful entrepreneur. He is a professional MMA fighter. We'll get into that in more just a little bit when we bring him up formally. But today, here's what we're covering. If you're an accredited investor and you're looking to enhance your current portfolio, this is the right spot for you, okay? If you don't know what accredited investor means, you still might be in the right spot. What it simply means is that you earn 200K or more per year as an individual, or 300K or more per year as a married household. Or there is a third way, you have $1 million in net worth, not including your primary residence. I don't make up those rules. Those are made up by the government, and they do that to basically segment who can invest in certain things and who can't invest in certain things. So if you think you're in that bucket, this is probably the perfect webinar for you. If not, and you aspire to be, you can still hang with us. We're going to be teaching an incredible amount today that could probably help you get on that path to be an accredited investor. So today, what we're going to be covering is understanding the different types of real estate investments. Believe it or not, real estate, it might seem like it's this giant never-ending ocean. What it really is it's about an inch deep and about a mile wide. There are just so many different options. There's different asset classes. There's different structures in which you can get in. And we're going to be going through those today so that you can see which one might fit your appetite the most to match your goals. We're going to be going through market selection. There are good markets and there are terrible markets. There are some markets literally that people are fleeing from right now. I'll give you a little example. As New York, they just passed another law to stack on top of their rent control that's going to be driving even more landlords out of New York. We're going to be going through some of that today to help you isolate and select markets for your investments. We'll be going through different investment success strategies. we'll be going through a case study of a first-time syndicator. If you're not familiar with that term, don't worry, we'll break that down for you. And we even have a dictionary of multifamily terms that we're going to be giving away to everybody that's on the live stream with us today too. So as you have questions, feel free, use that chat. If you're following us on social media, type it in the comments. We've got team members that are watching the comments. We'll make sure that we get your questions answered before the end of this as well. So all of that and more. We'll also cover our upcoming events that we've got for the next couple of weeks as well. So I was up at 5 o'clock this morning and I was rocking my baby girl back to sleep. My wife goes to the gym and then she leaves the kids with me and baby wakes up. So I've got baby Abigail up on my shoulder. And once I finally got her back to sleep, I knew that I was going to be stuck on that chair for at least an hour. So I pulled up my little smartphone and I went to Barron's Market Watch. And I noticed that one of their top articles is that bonds are up. I'm going to flip over to this. So bonds are up. And those of you that follow the market and bonds, you probably know this. If you don't know this, it's okay. But when bonds go up, it usually means that stocks are going down or they already are down. They have this inverse relationship generally. And stocks have been bumpy the last couple of weeks, especially since basically Christmas time or so. There's fears of tariffs. There's fears of unemployment numbers, which again come out tomorrow. There's this whole roller coaster effect that can happen in the stock market. We've got bird flu starting to flare up. We've got huge fires right now in the Los Angeles area, all kinds of stuff. And we all know that with President Trump coming back into office, that it's going to be a little bit unpredictable. He's not a predictable person. So with all that said, when we're looking at different types of investments, we try to diversify. That's the best advice that we can really go after. If you read any of the writings of Solomon, he was the richest person in the Bible by far. If you compared him against Jeff Bezos or Elon Musk, he would be like 10 times richer than them based on the amount of gold that they had coming in every month. He always says that you need to have multiple ventures. You need to diversify. He says have 10, no 11 different ventures. And so as you're looking for your diversification, we want to point out something, okay? On this slide right here, you can see, and it's going to be about right here in the middle. If I can point to it at the right spot, I have to adjust a little bit. You'll see this line that says U.S. private real estate and its performance. It's definitely in the top 1/3, nowhere near the bottom. It does get a little bit flushed out behind private equity and U.S. equities. Some of those are tied to the stock market. Stock market, again, can have volatility. U.S. real estate, private real estate, it's one of the most steady trains that are out there. And one of the best parts about it is that it has steady income streams, stable income streams. We'll get into rent collections and things a little bit later, but that stable income stream makes it a lot, not as much correlated with the broader market as a whole. So as I sat there and I rocked my baby back to sleep this morning and I'm reading the Barron's article, I didn't fret. I didn't have angst. I didn't have worry. I didn't have to worry like, oh my goodness, are my stocks going to drop? Because I know that my real estate's not going to be affected by what's going on in the bond market. They're not related. There's not much of a correlation. So because of that reason, if you're looking for diversification, we're going to encourage you to look at U.S. private real estate. So what does that look like? What can you do in private real estate? Well, there's a big difference between public real estate and private. Let me cover the diversification strategies that you can go through. And by the way, I wanted to learn these and really teach these today because when I first got into this whole business, I was a Target executive. I invested into a big development project with a big developer. The developer ran from the project and left everybody hanging. And I didn't understand diversification. I had all my eggs in one basket, so to speak. And when that developer ran from it, I took it over. I got it done, but by the time that it was done, it ruined me. Like financially, emotionally, I left my home state. Like it really, really what rocked me. Thank God I found someone that showed me how to do this business the right way. They showed me step by step, and then I was able to make money from it. And not that long after, I had my first ever $1 million year. And so when I'm talking about diversification, like I want to show you these different options so that you know you don't have to have your eggs in one basket. You can still enjoy the benefits of real estate without being stuck in one little bucket or one silo. So the first one, a REIT. There are public and private ownership options. REITs, think of these most oftenly as publicly traded real estate entities. What they are is they literally are listed on a public exchange market, kind of like stocks are, and the firm invests into different real estate projects. If you like publicly traded, if you like liquidity, if you like being able to sell when you want to sell, check out REITs. It could be a good potential option for you. Okay. And I do want to go back for a second, though, to this slide right here. And I want to point out right here that REITs typically underperform actual private real estate ownership. My preference is actual private U.S. real estate that you own or your syndicate part of. REITs do perform well, but just a little bit under what my preference is. Okay, next one. If you currently invest in real estate, you can grow across multiple asset classes. So if you're currently, like I spoke with an investor today, he's got a fourplex, he's invested into some single family houses, and he's at the point now where his time is really precious to him. And he doesn't want to do any more of like the tenants and toilets. He told me on his fourplex specifically that he bought one by mistake that all the utilities are paid for by the owner. So he's got tenants that are basically abusing the heat system and the electricity, and he doesn't want to go deal with it anymore. And so if you're at that point, you could balance things out by getting into different asset classes. You could look at syndications where you partner with a professional that's doing all the work for you. You could look at potentially jumping into a REIT. One way or another, though, you could go into different asset classes. You could diversify a little bit. Okay. The next one. Number 3, balance your portfolio with passive investments. So currently, if you have rental properties on your own, or if you don't, you could. Sometimes people like to own 100% of the thing that they invest in. I know the gentleman that I spoke with earlier today, that was his initial thought. I want to own 100% of the grape that I have. I want full control. And what he learned after a few years is that owning 100% of a grape meant that it came with tenants, toilets, broken stuff, management, things like that. And he's come to a point, he's graduated to this point where he's saying, you know what? I don't need to own 100% of this grape. Instead, I want to own 10% of a watermelon. I want something that is professionally managed. I want to be able to do things and get my time back. And so rental properties can be an option. A lot of people start there. Just know that they come with the extra burden of actually taking care of them. The next one, passive investments without property management hurdles. This is my preference. It's to own basically 10% of a watermelon. And the way that you get there, instead of going after the 100% of the grape, you go after a bigger property where you partner with other people. You find one person or a group of people that are going to manage that thing and take care of it so that you can truly be passive. That's where you can trade. You can put your money to work for you and not have to trade your hours or your time to take care of that asset. Less stress, more money. That's the way to go, in my humble opinion. And then the last part of this is syndications, okay? Syndications, same model as what I just described, but you truly find a professional group that does it. A group that's dedicated in the space. One that day in and day out, that's all that they do. They manage assets like this. They take care of it so that you can invest your money passively and then not have to worry about any of the tenants, toilets, and things like that. So that's the one that most people that I know lean towards. Okay, next. I promised this in the beginning. I'm going to make sure that we get it out there. Philip, if you could help me put this in the chat, or CJ, we have a book. The team spent a lot of time working on this, and we're going to give it to you as a gift today. Okay. It is called Real Estate Syndications 101. I'm going to cover a couple of the main points of it right now, but that book will be a gift for everybody that's on with us today. If you're following us on social media, just type the word book in the comments and we'll get that over for you as well on social media. So what are we talking about when we're talking about syndications? There's 2 main roles that we need to cover. Role number 1 is general partner. The general partner is responsible for managing the syndication. They make the key decisions about management of operations. They handle getting the loan on the property. They handle the insurance. They handle all the investor relations. Our Kentucky properties, if you guys were watching the weather at all in the last couple of days, the Midwest just got hammered with a record snowstorm, bigger than they've seen in the last 25 years. And so you can imagine the general partner for all of those properties, that was us in our investors' case, we were taking tons of phone calls, tons. We had to find snow removal people. We had to find people to go put out salt to make sure the sidewalks weren't getting icy. Like, it was a massive, massive operation because they just haven't seen that much snow before. Meanwhile, our other partners, our silent partners, the LPs, which we'll talk about in a second, they never got bothered. Not one phone call to them. So GPs, they take the action, all the busy side of it. That's what the GP's job is. And for that, the GP typically invests some of their own money into the property, but the GP really, they earn their share by doing the work to make sure that the asset performs. Now let's talk about limited partners. LPs, as they call them in the industry. That's where a lot of folks, you might consider being an LP at some point. LPs, limited partners, they contribute capital, but they don't have to participate in the day-to-day management of the asset. They enjoy truly having a limited liability. What that means is that they don't have to go sign the loan. They don't have to deal with snow phone calls or broken tenant phone calls or troubled tenant phone calls or broken toilet phone calls. Limited partners truly get to be limited in the action. And at the same tone, though, limited partners are entitled to all of the financial benefits and sometimes more than the general partner. That's right. Limited partners can earn more than the general partner because there's something called a preferred return, which we'll talk about a little bit later. I want to switch gears a little bit, though. And I first want to talk about the demand metrics that you need to know when you're getting into market selection. Okay, this can make or break an asset. A lot of people that jump into real estate, they look for the pretty property that's maybe near their backyard, and they go for that because they think that because it's beautiful and it's close to them, this is going to be the one. But I can tell you right now that beauty doesn't win the day with real estate. If you want to really win in real estate, you have to find a market that's working in your favor. Think about this. If you start buying in a market, let's just say Detroit, Michigan. I bought a lot of stuff up in Detroit before it went bad. But there was a time in Detroit where it was booming. And then all of a sudden, the auto industry pretty much shut down by 2008, 2009. Could you imagine if you owned assets in 2008 and 2009 in Detroit, when you got a third of the city exiting the city, leaving, literally leaving, because there's no jobs left? What would that do to your asset value? What would that do to your rents or your rent collections? How do you even collect rent? I started buying up in Detroit, Michigan in 2011 after they fully hit bottom and they started to come back up a little bit. And I got some incredible scores up there. But you have to select the right market based on the following. And if you hear nothing else from me today, then make sure you take these, okay? Number one, population growth. What do I mean by that? I mean this. You should be able to go onto Google and type in your city and state that you're investing in, even your zip code, and you should be able to see a positive trend. So Oklahoma, this is a property, we just bought an asset in Oklahoma. We're looking at another one right now. In Oklahoma, specifically Oklahoma City, Del City, where we just bought, it's coming up. Like, it's growing. It's on a growth trajectory. The most important part of the population graph is right here at the very end, okay? If you start to see that it's tailing off, that's not a good sign. If people are leaving, like the Detroit example I gave a minute ago, that could mean trouble for your investments. Or here's another one. This is Florida. Look at this growth curve in the state of Florida. Like, if you own an asset in Florida and you're walking into a growth curve like this is a really good sign. This just puts more pressure. It shortens the supply of housing, which inevitably leads to higher rents, which then if you're a building owner in multifamily, it leads to higher valuation of your building. This is the kind of curve that you jump for, you get excited for. Let's check out this one. This one's Kentucky. Kentucky's a little bit more modest, a little bit more flat, but it's still going up. It's still going in a positive direction. These are the kind of curves that you want. Now, if we compare that instead to California, I want to point out the tail of this right here. You see this tail going down? If you can see that, just put a yes in the chat. I want to make sure you're following with me. This little tail coming right down over here. That tail right there, that's what you want to avoid. Now, what's going on in California? I know that there's wildfires like crazy, and we care about and we pray for the success of the leaders there to help the people that need it. But what's going on a broader scale in California? They've had some policies that they've passed over the last decade that are driving people out. California is losing more people to the state of Florida than any other state that I'm aware of. And so if you're a landlord or if you own assets in the state of California, you might be concerned. You might get worried about this trend. If more and more people start leaving, there's no one left to rent to. Your rents are inevitably going to have to drop. Okay. The next one we need to look at, I'll flip back to this slide. It's number 2 is job growth. So we talked about population growth. Now let's talk for a second about job growth. I could go on and on, like Louisiana is kind of tailing off. Well, let's go into job growth. I'm going to take you over to a site called BLS.gov. This is the Bureau of Labor Statistics. The jobs report officially from the government comes out tomorrow. If you want to start spying on what the data will look like, you can come into BLS.org. They won't post it until tomorrow, and they'll publicly release it to everybody. But you can start to see quarter by quarter what the jobs report looks like. If you have a city or an area that has trending population up and has jobs that are going up, that's a really good thing. Now, right now, I am in, let's see, this is the state of Ohio. I want to point out the jobs report for the state of Ohio. You're specifically going to look at this thing they call total non-farm. Why they titled it, I don't know. This is probably a very dated name for this report, but total non-farm jobs, that's where you want to look. And I just want to point out 0.7, 0.8, 0.5, 0.7, 0.9. I see some negatives in some of their different categories right down here. Negative, 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 negative. Now, pretend that you know nothing about this report because you probably don't yet. I'm going to compare it to another city or another state, okay? Lots of negatives, and they're all below 1. 1 represents 1,000, okay? I have now stepped into the state of Florida. I'm going to scroll down, and I want to show you their total non-farm right here. Total non-farm, 2.1, 2.2, 2.1, 2.0. Which one's better, Ohio or Florida? Knowing nothing about the reports, and I haven't taught you the metrics yet, but knowing nothing about the reports, which one sounds better, Ohio or Florida for job growth? Ohio or Florida? Which one sounds better based on what I've shown you so far? Remember, Ohio, we had some negatives down there, and we've got a lot of 0.7s, 0.8s, 0.5, 0.9. This is representing for Ohio that they're actually losing jobs. They're losing. Florida's gaining. Florida's gaining right now. So when you're looking at this report, you want to see at least a 1.0, which is maintaining. When you start to get into the 2s and sometimes even 3s, that is fantastic news. Okay, here's another one. This is the Nevada. Check out Nevada. Look at this. 3, 3.2, 2.9, 1.9. Nevada is kicking butt. Actually, I got to point that out to my co-CEO, Chris. Nevada is kicking butt, Chris. We really ought to look at Nevada in the future.
I understand.
Okay, cool. All right, so you want population growth, you want job growth. Those are the first 2 most important. So everyone remember that. If you were taking notes, write those 2 down. You should not buy assets unless those 2 are trending in your favor. Those 2 are working in your favor. Even if you buy the ugly duckling property, if those 2 are trending in your favor, you're probably going to see rent growth, which means you're going to have valuation growth, which means you could have a really good exit if you decide to sell someday. Okay. The other ones that are a little more subtle, but you should look at is business growth. Are businesses investing into the area? We have a property up in Lexington, Kentucky that literally right down the street from it, I drove. It's about a 6-minute drive from our property to this facility. The Toyota plant, which is the largest Toyota manufacturing plant in North America, the Toyota plant just made a $1 billion commitment, 1.9 billion, to expand and start doing EVs in that same facility. When you've got manufacturers or producers that are committing to more jobs in the area, that's a good thing. Watch for that. Those drive rents up. You want that. And it's no wonder that that particular asset that literally the moment that we have a vacancy on it, are formerly, like, we took that building over at $650 per month in rent. We are signing leases today at $1,025. We've only owned it for 2 months. Imagine that, going from $650 to $1,025. That's a big hike. It might sound a little bit superficial, but it's real. We've literally pre-leased 3 units. Before even the last lease expired, we pre-leased 3 of them. So when you've got jobs like that, that makes a huge difference on your asset. The next one, yeah, Chetna says almost doubled. You nailed it, Chetna. Next one, public sector infrastructure. When you hear that there's big projects coming in, years ago, this is about a decade ago, I used to invest in the Quad Cities area. That's where Illinois meets Iowa. And in that particular area, they were building a giant bridge across the Mississippi River. And during that bridge construction, there was about a 2-year period where every hotel, every Airbnb, every rental in town was completely full. It was crazy. And it was kind of like printing money if you were in that business. If you had an Airbnb, if you had a rental, anything, it was like printing money. Now today, that bridge project is done. It's been done for a few years. And the bridge project's done, and most of the contractors that were working on it, they've moved out. They're gone from town. And so you have to watch infrastructure. If it's coming in, it could be a good surge for you. It could be something to watch for, but also watch for the tail end of it when it starts to move out. The last one that I'm going to point out, but it's also important, is this: housing affordability. When you buy an asset, you have to make sure that this rule is followed. Okay, so I'm going to take you to, this is our Lexington, Kentucky property. I'm going to put it up on the screen if it will load. Okay, these are not great pictures, but I just want to show you an example, okay? So we own this building. It's got apartment units in it. These apartment units rent from, like I said, 2 months ago when we took it over for $650. Today they're renting for $1,025. Now, I want to know if my tenant left this rental and to go buy a house in the same zip code, in the same area, how much are they going to have to spend per month? You need to know that number. How much will they have to spend per month? And so what I do is I usually go to Google and I say, hey, Google, for this particular zip code, what is the average home price in the area? And if you do that, I already did the search. Google came up and said, you know what? It's $307,000 in this area. So then what I do is I'm going to figure out, if someone were to go buy a $307,000 house, how much would they be paying each month on that property? And so I'll come over here and I'll put it in this little calculator, this mortgage calculator. And I want to see, look at this. If you can see that number, type it in the chat for me. How much would they be paying per month? If they were to go buy a house in this zip code, what are they paying per month? Yeah, you guys are good. This is a good group. You guys are awesome. Yeah, about $2,301. Imagine that. So remember, our rent, max rent right now is $1,025. They're going to have to go spend almost twice as much. They're going to spend more than twice the amount if they're going to go buy a house. Who has the advantage? Home seller or me as the landlord in this market? Who has the advantage? My rent is $1,025, and it's a good, clean not a furnished unit, but a good, clean unit. If they're going to go buy in this market, they're going to go spend $2,301. Right now, it's one of the best times to be a landlord because this plays out more often than not. In some markets, it's not the case, but today, this market is the case. But you still have to make sure that it's true for the zip code that you're buying your asset in. It's not always true in every single city with every single deal. Okay, so what markets are we in or are we looking at right now? We presently have a deal under LOI in Iowa. Why? Because jobs are coming in. Population's still growing. It's not a Florida. It's not exciting like the Florida curve and all that kind of stuff, but it still has growth to it. Okay. The next one, Florida. Anything south of Orlando, we are making active offers on right now. We are screening tons and tons of deals. We bought a lot of deals in Florida over the years. We backed off for a little bit when they went through this whole change up with insurance prices and things like that. We'll talk about later. But Florida, right now, we are going after because why? Population's increasing, jobs are increasing. The Florida market's still a very, very solid market. Next one, Oklahoma, specifically Oklahoma City. Why? Because population's increasing. Actually, Oklahoma City was in the top 10 the last 3 years in a row for population increases. That's crazy. There's a lot of reasons that it's being driven there. They're going to have the Olympics in just a few years. Los Angeles is hosting the Olympics, but they're subbing part of it out to Oklahoma City for one of the events. So that's part of it. And there's a lot of companies that are just hiring like crazy in Oklahoma right now, including Pratt and Whitney, the biggest jet engine maker in the world. They're actually setting up 6 minutes away, literally 6 minutes away from another one of our properties in Oklahoma City on the Tinker Air Force Base. It's pretty incredible. Next state, Tennessee. Tennessee, why? Population growth, job growth. Texas, same thing, population growth, job growth. And the last one that's on here is Wisconsin. Population growth, job growth. Not as strong as Florida, not as strong as Texas, but still it's holding its own. Milwaukee, Wisconsin specifically has a lot of manufacturing that's getting a resurgence right now. Ever since the Trump administration it was announced, they say the word tariff, and then everybody is running towards U.S. manufacturing again. So Milwaukee's going to have a little bit of a resurgence for that reason. So these are the areas that we're going after for 2025 and probably the next few years. And it might be areas that you consider too. I will give one other common denominator with these states that I didn't point out in the last slide. And it's this. These are landlord-friendly areas. What do I mean by that? I mean, they actually look out for the landlord. They don't try to gouge you like some states, like New York has rent control. I did a whole broadcast on that just the other day. But when you have a state that limits the amount that you can charge for rent, when you have a state that doesn't let you evict a non-paying tenant like California, some tenants can stay in properties in California for a year without paying. When you have states like that, it doesn't bode well for you as a landlord. So we want states that are landlord friendly. And Mark, you're asking the question, I'm surprised to see that Texas, Dallas, Austin, Savannah, Metro, we like Georgia, we do. We just had to limit our scope. We can't tackle all of them at once. So we've had to limit our scope to the ones that we know we can tackle with our boots on the ground and all that kind of stuff. Okay, next, and then I need to flip this over to Chris, okay? So I'm gonna cover this really fast. We can get you a book on this too, but there are some benefits to real estate that go beyond just the cash flow by a long shot. And it's really in the tax basis. I had a chance to start helping a really wealthy individual manage some of his money. His rule was that I had to work with his family office before he would give me capital to deploy. And so I went in and met with his family office, and his CPA in the room, he had me explain like what I do, how I do it. So I showed him how we get properties. I showed him how I bought a multifamily for $492,000. I fixed it up. I rented it. And then I sold it for 1.7 million. I showed him the whole thing. He's like, Nate, that's great. That's perfect. But we need you to change a couple of things because you're not very tax efficient. And I said, well, what do you mean? And then he went through and he taught me this whole method. We call it the Sarah method. And it works like this. I'm going to cover the tax important one right now so I can flip this over to Chris. Okay. He explained this thing called accelerated depreciation. Essentially, the government knows that all of us, when we invest in real estate, we're number one, providing jobs. Number two, we're also investing into something that is providing housing. And then number three, they know that it's going to wear out over time. Over time, windows start to wear, roofs start to wear, doors start to wear. So essentially, the government gives you these, I'm going to call it kind of like a coupon or a credit, but that's not the technical term for it. But they give you these coupons or credits that can help offset income that you make on the investment. For some people, if it's structured right, it can also offset your personal income. And so when the CPA taught me all of this, I'm like, holy cow. And we've since gone on now to literally help wipe out, eliminate a lot of people's income taxes when they structure this the right way. Now, I'm not a CPA. I can't give you tax advice. I'm making all of this for informational purposes only. I encourage you to take this to your own tax professional. A lot of people, they come back to us and say, hey, will you refer me your CPA? And we'll happily do that. Okay, so if you want to get individual tax advice on it, just let us know. We'll connect you with our CPA firm, the one that we use. I have not had to pay substantial taxes in the last handful of years. Almost every single year, because of the gifts, the blessings that accelerated depreciation come with, my taxable income has been wiped out. And God's blessed me with good income. It's just that I use the accelerated depreciation to wipe it out. So that and more we can get you. But I need to do this. I'm going to flip it over to Mr. Chris Lavin, MMA professional fighter, 13 wins, 0 losses. Chris, how you doing, man?
I'm absolutely amazing. I do want to add this caveat. I am long retired. It's not my game anymore. I am not a young man anymore. It's crazy. Not for me.
Man, when you told me about the 2 black belts that you have, I was thinking, you know what? I might jump in there. No, I won't. I'm done.
Remember, I can still bench press 275 pounds at 56 years old. So
that's quite impressive.
yeah, we still move a little bit around. How's everybody doing? How you doing, Nate?
This is an amazing group. We've got really sharp folks, Chris. So like they're ready for you. And before I let you take off, I will say this, just so you guys know, Chris is a highly successful entrepreneur. We joke about the MMA fight, but that's real. It's a real story. But Chris has built several companies, a lot of exits. Probably the thing that I admire the most about this man, though, is that he gives back. When we talk about this statement of believe in more, like Chris is the reason for it. He gives to so many people, so many causes. He's helping so many people out there. So, Chris, thanks for being here. I'll flip it over to you, man.
Fantastic, thank you. So listen, real quick, I want to go through. Are you going to keep the slides up? There you go. I just want to kind of go through this real quick. A little bit of background on me and how and why I'm sitting here today. So as Nate pointed out, I've been in and out of a lot of businesses. I built most of the businesses that I have been involved in from scratch, ground up. $0 from the very beginning, built the business and exited successfully. Now, a lot of people like talking about their successes. I've had failures along the way, misguided missiles, things that didn't go in the right direction. But the reality is I built some substantial wealth by starting businesses, building them, and moving forward. In around the 2008 era, very successful in commercial real estate. I did about $150 million in transactions, complete cycles, made a lot of money, found some tax loopholes, did it very successfully. Now, the reason that I'm sitting here today is that I built a business in the process of exiting that business, and it's an 8-figure exit. So when you start from nothing, get to 8 figures, there's a lot of capital gains tax involved in that. So I know about real estate from my history with real estate, but I knew that there had been changes and there's tax law changes and all of this, but I know I had to do something to offset those capital gains. So I started researching just like everybody else on the internet. And man, I bought a few of those packages where you spend $9.99 and they're going to make you a multimillionaire overnight. I'm going through all that process, a lot of learning. And then I come across Nate. I don't remember the specifics of the particulars as to how. Connected with Nate, got involved in one of the programs he had then. And what I did is I purchased that program. And this is very key. I did the work. So one of the most important things that you can do, like no matter what you sign up for, there has to be work behind it. So I did all the work, went through the program, went through the courses, did everything I was supposed to do on my part. And Nate's team was there to support me. And my first transaction, $15 million apartment complex, boom, out of the gate. So since then, I've had many successful transactions. But one thing I want to point out, is that there's a lot of ways to go through life and learn things. There's trial and error, school of hard knocks. That's not fun when you start talking in these dollar amounts. So there's no way that I could have went out and purchased my first $50 million property, knew how to operate it, knew how to make the transaction happen, and all of that stuff without any help, right? I took all the courses and I did all that, but I needed mentorship. A heart surgeon, he goes to school, learns how to become a heart surgeon. Well, the day he gets his diploma, they don't turn him over and let him go do heart surgeries. No, he has to go through his residency. He has to go through all of that stuff and learn how to do it side by side with somebody that knows how to do it so he can get the corrections and the guidance he needed. So I didn't want to do the trial and error. It's super expensive. I don't have a lot of time. Time is my biggest asset. Super expensive again. I could have went out there and learned and done this and done this and done that for years before I had the experience on my own to go out and make this transaction happen. So what I did have available to me, and what we all have a way to make happen if we're sitting here and we're accredited investors, is a little bit of money. So I decided to pay for my education with a little bit of money, which, by the way, alleviated me from getting a lot of lumps on the head and hard knocks and terrible phone calls and all of that stuff. So I learned how to do it, did what I was supposed to do, did the work, invested in myself that way with the work, and boom, $15 million real estate transaction, many successful transactions. And now I happen to be co-CEO of Home Invest. So that's the important process, right? Is get committed, find the right people, which I like to think is us, get behind it, do the work, and you end up with results that are successful. So back to something else that Nate was talking about. First foray into multifamily residential real estate for me. There's no way that I wanted to go and operate a property completely. And you as first-time investors, or even you as savvy investors, I encourage you to not get involved in the cons of real estate investment, right? There's two sides of the equation. There's the pros and the cons. The pros are, great cash flow, tax benefits, ownership, yada, yada, yada. The cons, 2:00 in the morning, backed up toilet, fire in the building, hurricanes coming, snowstorms coming. You got to deal with all of that stuff. Those are all the cons that you don't have to deal with. If you get involved with syndicators like Home Invest Group, who are knowledgeable and professional and have got the experience to go out and deal with this stuff. We've got professional property management teams that deal with each and every property. You get all of the pros, the tax benefits, the ownership, the cash flow, without the cons, the 2:00 in the morning phone calls, the slip and fall accidents, all of that stuff that you just don't have to deal with. So the cool thing about Home Invest Group is I like to think, and I happen to know for a fact, but I'm not gonna dictate it as facts to you. You need to do your own research. We're different than other syndicators. Nate pointed out why. So our mentality and our mantra is we believe in more. What we have come to find out is that if we contribute positively to society through our tenants and through other causes, our profits come in without us trying. So the profits that we have are a result of our actions, and those actions are not necessarily to pursue profits as the end goal. Again, we go to impact the world, even if it's one person at a time. For example, one of the things that I think Nate mentioned was our Toys for Tenants that we do in our properties. We affect people. We make them feel good about where they live. You know what that does? It keeps those tenants from moving out. So if we have a high tenant retention and high renewals on our leases, we don't have to spend the marketing dollars to get new tenants. Total cost of ownership comes down. If we invest in the community, improve the community around us, people find a great place to live. Again, tenant retention, they're telling their friends, their family members, other people are moving in and supporting our community. We have lower theft, we have lower vandalism, we have people that care about what's going on, we have neighbors looking out for neighbors. We're impacting these people one person at a time and making that little community and then hopefully the world a better place. So because we believe in more and we have dedicated ourselves to altruistic practices and purposes, our properties just seem to just succeed. I mean, Nate was telling you about the property that we picked up and how the rents go up. Well, people are happy to pay it because we clean the place up. It's a great place to live. There's a great community. So one of the other things that we do is we have both long-term and short-term strategies. Some of our deals, we ask you to be committed to for 4 to 5 years. We have 2 deals that were back to back, where they're what we call our forever deals. And what happened with those deals is we worked so diligently to find such ideal deals that our investors were able to invest. They'll be in for 2 years. We'll refinance those properties, give them back their capital, and yet they'll maintain their equity position in those properties. So as a result, they'll have their cash back and continue for all perpetuity, as long as we own that property, to continue to get dividends or rewards from that property, even though they've got their capital back. And because of our experience and because of our ability and quite frankly, Nate's expertise in property management, we're able to, and because of our total footprint, we're able to take the prices and the costs and expenses of each one of our properties down. So you can see the benefits of 18 to 22% IRR across the board. We've been very successful on our exits. We've been very successful on our investment strategies. And we've also been blessed to have never, not once, missed a payment. We return our pref returns to our investors after the first quarter of ownership from day one. So, and that's another amazing thing. One of the things that we do as syndicators is we absolutely 100% put our deals in a box so that when we purchase a property, after that first full quarter of ownership, you will receive a check. And for me personally, I don't take profits out of these deals because of the exit out of my other business. I'm doing very well financially, but what I do take is the tax benefits. So those tax benefits allow me to hang on to more money and to have a more positive impact in the world. And me personally, I've got a hard luck story that is, I don't really want to go into right now, but my passion is to help children and children that are struggling in the world. So the more dollars that I have retained instead of paying taxes, the more impact I can have in that way. So as a result, very tax savvy. Everything we do, we look at what's the tax benefit. Is it better for us to spend $1.50 this way or $1 that way? And we definitely always work those equations so that we return the best profits and the best tax refunds to our investors. So we're going at it every possible way. Not only are we making it so that you're earning money, we're working on every possible idea and way and possibility for you to get the best tax benefits. So you're not giving your money to the government. Listen, I have no problem giving to Caesar what is Caesar's, but I also know that the government is very bloated, not a political statement by any means. Don't matter which side of the aisle you sit on. The government spends more money to accomplish things than I ever would. So I do the best that I can to retain as many dollars as I can for not us, but for our investors. And I'm here to tell you that as a result, our investors are very happy, and most of our investors are repeat investors and just keep coming back with us. As we cycle deals, they come back in, or they bring more capital, or they in fact bring more family members and friends into our deals. So we cover the whole gamut. We got learning, we've got classes and courses, we've got consulting, and first and foremost, we have syndication deals to help you be successful. So when you're ready to take that step into the pool of investing, we're there to help you, to hold you up, just as you learn to swim and do it on your own. But that's the bottom line, is we're here for you from the beginning to the end, and we really care about your success, because your success is our success. I think that's all I got, Nate.
Thank you, Chris. I now understand how you went 13-0 in the ring. You got this energy, man. You got this smoke. I love it.
Thank you.
You got comments in the chat right now. JW said this is The Forge. It's like The Forge, a great movie, great team to forge in real estate. Thanks,
Thank
JW.
you very kindly.
All right, so I want to highlight something, and I think Mark's on the webinar right now too. And Mark, I'm going to say it to you, and I'm going to address it publicly. We really appreciated this comment from you and Cindy. Like this, yeah. We celebrated this in the office. What Mark said is, you have been phenomenal and intelligently led us through investing and building a home invest relationship that we hope grows more and more each year ahead. Everything that you send in, Mark, we love it. Thank you. We appreciate you and Cindy both. And this really lights us up when we get these kind of comments. Right now, we are Last time I checked, we are the highest reviewed in our niche. We've got a 4.9 out of 5-star review on Trustpilot, and there's not many people that can maintain that. And I think that the biggest reason that we're able to do that is because we genuinely care. We listen. When something's not right, we will always be the ones that make it right. So thank you for that, Mark. We're going to do this. We've got some time set aside for Q&A, and then we've also got some time set aside to look at some investment opportunities. If you've got a question and you haven't already put it in the chat section, please put it in the chat section. Type it in there for me, and then we're going to go through and make sure that they get answered before we depart here. But I'm going to quickly go through our investment opportunities. If you're looking at a potential investment that you want to make somewhere in the near future, I'm going to show you what we have available right now. And these are almost full. These are right at the very tail end. So these will fill up pretty fast. But we got a little bit of room left. So there's 3 spots left on this one. This one's called Morgan Terrace.
No, Nate. Nope. That was going, buddy. There's only 170K left.
Okay. I got to update the slide. So it's filling up. And that's a true statement because I know, Chris, you met with an individual this morning for investment. So what this is, these don't come around very often, but this is one of those deals that Chris mentioned that could be a 2-year deal. You put money in, we go to work, we improve the place, we make it look pretty, we raise the rents on it, and then we go and do a cash out refinance. All that means is that we get a loan on it, we use the loan to pay back our investors, and now you own a piece of real estate that cash flows forever. These are beautiful when they come along. It's only about maybe every 10th or 11th deal you can get something like this, but this is one of those deals. That's why it's filled up the way that it has. So there's a little tiny bit of room left on that one. If you wanted to make a move and be able to get in part of a forever deal where you get your money back in 2 years, then book a call with our team for that one. Doug, oh, Sue, you're here too. Awesome. Sue and Doug just put the links in the chat. Sue and Doug on our team are our advisors. They've both been in the space of investment for a long time. They invest in projects themselves. They know this arena really, really well. So you can jump on a call with them. Just use that link. If you're following us on social media and you're like, Nate, what link are you talking about? Then write the word call in the comments, CALL, and we'll reach out to you. We'll get you the link. This next one right here, this is the property that I mentioned up in Kentucky. It's technically, I said Lexington. It's technically Georgetown, which is a little submarket just on the north side of Lexington. I'm going to pop it back up on the screen here so you can see it a little bit better. Oh, wrong one. That's my calendar. That's what I did for my birthday. Let's go ahead and put the property back up. Okay, here we go. So this particular property, this is the one that we took it over at $650 per door 2 months ago. We've already literally leased 3 units at $1,025. The base rent is $950 plus a $75 garage and parking fee. So $1,025. Imagine that jump. The jump is not because we're like, rocket scientists or anything like that. We just understand supply and demand. We bought the property knowing that it was under rented, and we knew that Toyota was adding $1.9 billion onto the facility. They were adding more jobs, and we're benefiting from the population growth and the job growth in that market at the same time. So we're renting much higher. This one has about $300,000 left. We've already raised probably $3.4 million on this property. We'll cap it at 3.7, and then this one's officially closed. If you want to partake in that one, then book a call with our team.
Before you go on to that one, can you back up? I'd like to brag a little bit. So if you're looking at this OM right there, I want you to look at that interest rate. That's right. It says 4%. We actually got this deal in the middle of interest rate hikes at 4% because of our reputation, because we execute and operate the way we do. We 100% have confidence of the people that we get involved in, and we've got 4% owner financing on this bad boy as a result of who we are and the way that we operate. Again, bragging a little bit, but that's the reality. 4%.
Yeah, that's that 4% number right up over there. Oh, 4%. Chris, good that you pointed that out. When anybody's going to get a loan right now, like if you're going as a new investor to get a multifamily loan right now, you're probably going to hear 7. It's probably
if you're lucky.
If you're lucky. Yeah, it might even be higher than that. So we got this one done at 4%. Okay, last but not least, and this one I know we've just took in 650,000, so this is in the 800 range that's left. This is a lending opportunity. If you're like, well, hey, Nate, I don't know if I want to tie up my money for 2 years. I'd rather do something more short term. We have an opportunity where you can be the bank. You can put in money and then we'll give you a return. We'll give you a fixed rate of return every single month. This one's paying out 10% fixed. What that means is that if you put in $100,000 over the course of a year, you're going to get 10 grand back. That comes in monthly payments to you. And we've got terms that range all the way up to, depends on how long you want your cash out, but they can be between 1 year and 2 year. This particular asset is a commercial asset in Dayton, Ohio. It is an industrial asset. It's a manufacturing facility. Our firm, we primarily invest in multifamily, but we also invest in some industrial. Manufacturing happens to be doing quite well right now, and we're forecasting that it's going to do even better this year because Trump is putting out tariffs. A tariff just stands for a tax on imports. So imagine all the US companies here that have been manufacturing overseas the last handful of years or decades, however long it's been, when they have to pay extra tax to get their goods brought into the United States, it forces them to rethink whether they want to do manufacturing offshore or onshore. And so a lot of companies right now are deciding to manufacture again on US soil. So it's benefiting facilities like this, and we've seen a pretty big surge. We own 6 of these already. This will be the 7th one. And if you'd like to partake with us, you could be a lender on this. A lender does get a secured lien position. It can either be on real estate or it can be on one of the pieces of equipment inside the facility. For any of these options, if you'd like to explore more, just use that link to book a call with us, and we're happy to go through it with you. Chris, I'm going to flip this thing over to questions and make sure that everybody gets
one from Kristen, Nate. I don't know if you guys caught that. I was a little bit earlier. I wanted to just cue you that she was asking when you were talking about structures is I've got a number of people, 3 or 4, I think it was, Kristen, that want to invest with me. Do I have to open an S Corp?
So you want to basically take their funds and then invest it into what? Help me understand that. If you're going to refer everybody, let's just say to a syndication where the syndicator already has the structure set up, then you wouldn't have to form any entity at all. Like our syndication deals, as an example, investors come, they we have one investor that referred a friend who then referred a brother-in-law, and all 3 of them came into the deal, and they didn't have to go create an entity. Now, if you're talking about going and creating your own deal where you're going to buy it, we're not attorneys here, but we'll just tell you from our stance, like we create a new entity every single time for liability, for protection, for anonymity. Actually, Chris, why don't I throw that over to you?
Sure.
Like you really like structure.
Yes. So yeah, for every one of our deals, we have an individual legal entity. We utilize LLCs for regulatory purposes. It just makes life easier. But each and every one of them is an individual LLC. So yeah, if you're going to take other people's money and invest in properties, as I'm seeing there, you would do a new entity for each property. But man, that's, doing it by yourself that first time is always going to be a scary, scary deal. I would recommend that you get some training, Kristen, and grab on one of our courses and make that happen, and invest in a few deals on your by yourself or for yourself initially, so you understand the process and get a little bit more education. But just jumping out there with other people's money is risky, and you can make a mistake that could land you in jail when you start dealing with other people's money. Scary stuff.
Cool. Thanks, Chris.
Yes, sir.
Kristen says, scary for sure. Where are those courses? Already invested in own deals. Okay, so she's already invested in owns deals. Where are those courses? Paige, do you want to take that question? Since you're
the
lovely Paige Steers, everyone, CMO, Home Invest. This lady is the marketing maven in the industry. Paige, take it away.
Greetings. Thank you for your question, Kristen. It sounds like you've already got a great education on it, and anyone, like we always say here, can continue to learn. So if you go to our website, you'll see an Academy page. We were seeing pictures of it on one of the slides here, and you can look at the type of courses. There's a tab there for courses, and you can click onto it and then eventually get all of the courses that you'd like to send. And then what I'll do for you is just send you a link also where you can get it and get more information about how to get involved. And we are not the most expensive place at all. It's very reasonable, and it just continues to help you go through. So if it's not a course you need, or you think you might need something like Christopher Lavin mentioned, a little bit of consulting hours just to help you through things. Our team also does that too.
Thank you, Paige. If you have a question and I happen to miss it, I apologize. Go ahead, type it in the chat again. I want to make sure we get it addressed, or you can press the hand wave button. One way or another, we'll make sure that we get it handled. Lydia says, what's the website? It's homeinvest.com. Homeinvest.com. Once you're on that page, you can click on the Academy tab, and that's what Paige was referring to. Kristen's asking, Paige, can you tell us how much that would run?
They're raised anywhere from 97 to 2,000 for some of the big courses. And then of course, there's some more detailed masterminds that are really up to 9 to 12 weeks that get much higher than that, depending on what depth of learning you need. So there's a variety that could fit for everybody.
Cool. Mark had asked the question a little bit earlier. Does that mean that you can grow rent rates? So Mark, yes, you can grow rent rates as long as there's demand for it. If you, sometimes people will buy a property and they'll just assume, if I make this thing beautiful, I can grow the rent. And a lot of those people have failed to recognize what the competition's doing. Austin, Texas right now, biggest rent drops in the country, biggest vacancy rate in the country right now. Why? Not a lot of developers anticipated that there would be 20 other developers building similar buildings in the same zip code. So consequently, when all of them tried to deliver at the same time, these new construction ones, it not only affected the new construction ones, they had to lower what they thought they were going to get, but it also affected the older housing stock. The folks that had buildings built in the 80s, the 90s, the early 2000s, they also had to drop their rents because of the absorption rate. All of these buildings, when they come on as competition, they forced rent rates down. Austin right now, it's getting close to where you could buy the deal of a lifetime. What I mean by that is that you're going to have to deal with high vacancy for probably a year, maybe 2. And most of the builders now have pulled up ship. They've left. They're not building right now. Ever since interest rates started going up, they've left. So what's going to happen in a market like Austin is they're going to go through about 2 years of pain. Let's call it 18 months. And then after that, they're going to go through another shortage of housing because of apartments like this, units, because all the builders, they went through so much pain, they just left. Interest rates went up, high vacancy, they're having to shovel out money to cover these costs. So, so can you grow rent rates? Yes, but you have to understand what the true market's doing. Do you have jobs increasing? Do you have population increasing? And then what does your competition look like?
Can I tell a horror cautionary tale along those lines? All right, so this, I know we're running a little bit long, but our Boxdale property that we recently acquired, the people that acquired that property bought it as a profitable asset that was operating fine. They didn't have to do anything except to continue to operate the asset the way it was. They purchased it, I believe it was for $5.7 or $5.9 million. But because they didn't know what they didn't know, first foray into the real estate market, they had seen these TikTok videos or YouTube videos or whatever, hearing how you become a multimillionaire as an operator of an Airbnb. So they decided it would be a great idea to take this beautiful property and turn it into an Airbnb. And they failed miserably. So that very same asset that they bought for $5.7 million, we ended up getting from them 2 years later for 3.5. Was it 3.5? 3.3 million. So the asset went from 5.7 to $3.3 million, different change in value in the course of 2 years. The result of that being they had a loan, the loan was coming due, they had to refinance, and they couldn't because the property had no cash flow, no NOI, there was no profits there. So they thought they were doing this wonderful thing, but because they didn't reach out for some experienced help, they ended up losing their shirts. And we went in there, we rescued them. They were glad to sell it to us before they went into foreclosure and bankruptcy. So that's a cautionary tale. Just because you think you know what's going on and you may have considered all the options, I strongly suggest that you get experience, which is what I did and why I've been able to be successful. So remember, just because you think you know doesn't mean you do know, especially when you get into a new field. And real estate might look glamorous and all this stuff, but there's a lot of stuff going on the backside that you just need to understand, or you're going to make mistakes. And Kristen, if you were to jump out and make a deal like that happen with other people's money, and then they started suing you, and then the SEC got involved, and you had the wrong document structure, you could possibly go to jail for fraud. So again, please, please, please do the right thing for yourself and the people you care about. Get the education and partner with some people that know what's going on.
Chris said exactly why I'm asking. Thanks, Chris.
Awesome.
Chris and I did a really big call earlier with someone that's developed over 7,000 units. They have resorts in Costa Rica, like very prominent real estate figure, publicly traded company. On that call, I remember, Chris, you were speaking truth like that. You said, Nate's kind of the nice guy. I'm the direct guy. And Chris, I like when you're direct like this. Give it to him just like this. Let everybody know, because it'll steer them from trouble for sure.
Yeah.
Okay, next. We have some events coming up. So if you're new to our world, or if you've been with us for a while, you're welcome to the following events, okay? Tomorrow, that's this Friday, tomorrow, we have a good one. If you want to see the pipeline of what's coming soon, if you want to be the first to know, join us tomorrow. Watch your email for that. You can, maybe I put this link in there. Actually, I can't. If someone could put the link for the call tomorrow in the chat, I'd appreciate it. Philip, maybe you could do that. The registration link for tomorrow. That'd be awesome. Tomorrow at 12 o'clock Eastern, we will be going through our pipeline. You can get a sneak peek before everybody else of what's coming down the pipeline for the next 3 months. So you can see what kind of deals are out there. Next week, we have a good lineup, 3 different events where you can jump on. Number 1, on Tuesday, we have the Opportunity Zone. Opportunity Zone is a live show we do every Tuesday. Chris and I will be on. We'll be jamming about all the current topics. We'll be talking about the Fed rate increases. We'll be talking about the jobs report, all that and more on Tuesday. On Wednesday, we'll be doing an on-site at the industrial asset. That asset that I just showed you a couple minutes ago, this one, will literally have one of our team members on site inside this place showing you around. If you want to see the inside of what the facility looks like, then jump on to the webinar on Wednesday. Watch your email for that. It's at 11 o'clock Eastern. And then the last one is on Thursday. Thursday's webinar next week, it's on 10 ways to make passive income with real estate. So you got a whole event lineup for you next week. We appreciate having you guys. Sorry we held you a little bit late. I hope that you got to enjoy some time on my birthday. I enjoyed it. Chris, I hope you enjoyed it. Thank
Absolutely.
You for coming and sharing, man. Elizabeth says, when do you get information about infrastructure coming in a particular area? Or where do you get information? Elizabeth, I Google search. So in Google, you can set yourself up for Google alerts. And I put alerts for anything in that city for a while. And then I go back and I edit that filter down if I'm getting too much. But Google alerts, that's how I get news on what's happening in a city. Kristen says, thank you for your time. Happy birthday, fellow Capricorn. All right, Kristen, when's your birthday? Oh, cool. Hey, you guys have been amazing. This crew that comes into Home Invest meetings and stuff like this, I love this. Chris just told me a week ago that he enjoys coming to work every day, and I want to echo that. Like, maybe I shouldn't tell you guys. You guys won't want to pay us to manage properties anymore, but I would do this for free. I mean, I would, because I really enjoy it. But keep paying us anyways.
You got kids to feed.
Yeah, yeah, I got kids to feed. I got a wife out there with a birthday cake in her hand. So with that said, thank you guys. We love you.
Happy
We'll see you
birthday,
guys
Nate.
tomorrow.
Happy birthday.
Thank you, Mike. Nice
Happy
to see you, man.
birthday.
Bye, everybody. Thank you so much.
Bye.